Our next reading is cash flow statement, and there are total 90 plus questions in this reading, so we will do them all. First question: the RR Corporation had cash flow from operations 20 million. RR purchased 5 million in equipment, long-lived assets, and sold 3 million of equipment during the period. What is RR's free cash flow to equity for the period? This is the formula that you will use to calculate the free cash flow to equity. You need cash flow from operations. We already have them. Cash flow from operations are 20 million. RR purchased 5 million in equipment. That's an outflow, negative 5 million. And at the same time, and sold 3 million of equipment during the period. So there is a net change in capital expenditure of negative 2. So 20 million is cash flow from operations and net capital expenditure is negative 2. So 20 net negative 2. 18 million is your answer, and 18 million C it is. Next. Which of the following is correct about the consideration of depreciation in the operation section of a cash flow statement? In direct method, what we do, we take gross receipts and gross payments. There is no depreciation involvement. We do not consider depreciation in direct method. But in indirect method, when we draw the reconciliation, we add depreciation to our net income. So yes, depreciation is considered in indirect method, but it is not considered in direct method. So that makes C to be the correct option, and C it is. Next. Question 3. Financial information for Jefferson Corporation for the year ended December 31st was as follows. What exactly do we need? We just need to know the requirements. So accordingly, we can do the working. Based upon this data and using the direct method, what was Jefferson's cash flow from operating activities or cash flow from operations? Direct method. Direct method is not a rocket science. You just have to be little sensible. You have to take care which items given here represents cash inflow and which items here given represents cash outflow. Like sales given here is a cash inflow. Using direct method, sales represents an inflow, right? Purchase is an outflow. Purchase is an outflow. All right. What do we do with ending and beginning inventory? We will discuss this a little while later. Let us take the other ones first. So sales represents an inflow, receipt, purchase is an outflow, account receivable, beginning balance was 300, ending balance is 200. It means they would have paid us. The difference between these two, $100,000, represents the reduction in account receivable. So the reduction in account receivable over the period effectively is an inflow. Since there is no change in account payable balance, opening and closing balance is the same, so they have no effect at all. And then other operating expenses paid. Other operating expenses, 400,000. Of course, it's a payment, so any payment paid out of operating expenses is considered as an outflow. So taking all these, now we have to be very careful about inventory figures. The point to be noted in this question is when you have been given the purchases, adjustment for inventory for opening and closing is not considered. When you have been given the purchase, you do not need to make any adjustment for inventory figures. Why? Because purchases incorporate the effect of inventory. When we will consider the inventory balances? When we would be given the CGS. If we have been given the CGS, CGS itself represents an outflow. And in CGS, we will have to make the adjustment for inventory. What you will do, when you will add, when you will deduct, we will discuss. But the point to be noted, when you have been given purchases, you need to ignore the beginning and ending inventories. You just need to sum up these all and you will get your answer. So 3 million less 1.8 million plus 100,000, and from this deduct 400,000. What you get is 900,000. So this is your cash generated from operations using the direct method, and $900,000 it is. Next, the correct set of cash flow treatment as they relate to the interest and dividends received according to the US generally accepted accounting principle. How do we treat interest and dividend received under the US GAAP? For this, you need this comparative analysis. Remember, interest paid or received, they are considered as a part of operating section. Dividend paid specifically is considered as a part of financing section under the US GAAP. That must be kept in mind. Dividend payments is a financing outflow. And if the dividends are received, they are considered as a part of operating inflow. Since we are talking about the interest and dividend received, interest received and dividend received, they are both considered as a part of operating sections. So it's a part of cash flow from operating sections in the US GAAP. What about IFRS? IFRS says that interest and dividend received may be considered as operating or investing cash flows. Cash flow from operating or cash flow from investing. But in the US GAAP, interest received, dividend received is operating cash flow, interest paid is operating, whereas dividend paid explicitly, remember, it's a financing outflow. So we got the answer C. It is correct. Next. Again, the recommended approach is that you need to first see what is exactly required. Under the US GAAP, mark industries cash flow from operations. It doesn't say so whether should we use the direct or indirect. Whenever the question is silent, information definitely is given that could be used in indirect method. What we do in indirect method, we start with the net income. To this net income, we add a depreciation in full. Now, listen to me very carefully. Wages payable increased. When a liability increased, you have withheld cash. That's an inflow. Holding on to your liabilities, if the liabilities go up over the period, effectively it's a cash inflow. Wages payable increased, you didn't pay. When you don't pay, it's a cash inflow. Accumulated depreciation increased by 2.5 million and the same amount is being reflected here as depreciation expense. So increase in accumulated depreciation is the total depreciation expense for the period and it would be added because it's a non-cash expense. Correct? Already considered. Interest payable decreased. If interest payable has decreased, when a liability decreases over the period, that means you have paid. It's an outflow. Income tax payable increased. Increase in liability means you have withheld cash. It's an inflow. And dividend payment will not be considered as a part of operating cash flows because explicitly dividend payments are shown as a part of financing outflow. So considering net income, to this adding your depreciation, adding wages payable increase, deducting interest payable decrease, and to this adding 500,000 for income tax payable. So that gives you 5.9 million as the cash flow from operations and 5.9 million it is. That's B. Moving on. DART Corporation engaged in the following transactions earlier this year. What do we need? With respect to these transactions, should DART report transaction 1 as a financing cash flow or should he report transaction 2 as an investing cash flow? We need to read what the transactions are. Transaction 1 says retired long-term debentures with face amount of 10 million by issuing 500,000 shares of common stock to the bondholders. What we have done, we had some bonds to be redeemed. So how did we redeem the bonds? We simply issued the shares and extinguished the debt. There is no cash inflow, no cash outflow whatsoever. It's a non-cash transaction. It can't be reported within the body of cash flows. Ignore that. Transaction 2, borrowed 5 million from a bank, inflow, and used the proceeds to purchase equipment used in the manufacturing process. Yes, cash is coming in and cash is being utilized. How can we see that? 5 million has been borrowed from a bank. It's a financing inflow. And using the same amount we received as a form of loan to purchase equipment, it's an investing outflow. Yes, this transaction 2 involves cash investing cash outflows. Correct. So only one should be reported and that's the transaction 2. So that makes B to be the correct option and B it is. Next. We have to segregate cash from investing and cash flow from financing. For that, we need to read the question carefully. For the year ended December 31st, year 2007, Gremlin Corporation reported the following transactions. 5,000 shares of preferred stock were issued for land with the fair value. It does not involve any cash inflow or outflow. We have just purchased land by issuing preferred stock. No cash is coming in, no cash is going out. Next transaction, purchased a patent for 3.3 million cash. It's an investing outflow. You are purchasing a patent, which is an intangible asset, acquiring an asset and paying the money for that. It's an investment outflow. Next, acquired 40% of the common stock of an affiliate for 2.7 million cash, which was borrowed from a bank. Now, there are two aspects to this transaction. First, we have used this much money to purchase 40% of the common stock of an affiliate. It's an investing outflow. And where did money come from? The money came from a bank loan. It's a financing inflow. So effectively, we have two types of investment outflows, 2.7 and 3.3. It's a total of 6 million outflow from investing and 1 inflow from financing. That's the loan that we have taken. So 2.7 million inflow from financing and negative 6 million outflow from investing. So that makes A to be the correct option. 6 million outflow from investing and 2.7 million inflow from financing because we borrowed from a bank. Apparently, let's read the option 4 and 5 as well, even though we know it won't have the effect. Why? Exchange equipment with book value 1.7 for equipment 2.1. We have exchanged equipment one for another. It does not involve any cash inflow or any cash outflow. No cash impact whatsoever, so it cannot be reported anywhere in our cash flow statement. Ignore that. Converted bonds payable with a book value 5 million into 50,000 shares. Bonds are being converted into shares. It does not involve any cash inflow or outflow, so they have to be reported, but they cannot be reported within the cash flow statement. They are changing our liability. They are changing the number of shares outstanding. Yes, these are the transactions, but they do not involve cash. Where do we report them? We report them as a footnote to the cash flow statement, just after the cash flow statement, indicating what transaction has occurred through non-cash investing, non-cash financing. Remember, all the non-cash investments and non-cash financing transactions that do not involve cash must be reported at the foot of the cash flow statement. So in this question, we got the answer. It's A, negative 6 million for investing and 2.7 million inflow for financing. So that makes A to be our correct option. Next, how does decreasing accounts payable turnover? Accounts payable turnover is how many times do we pay to our accounts payable. How do we calculate that? Your credit purchase for the whole year. If credit purchase isn't possible to extract from the given numbers, take the total purchase. Credit purchase divided by your average accounts payable. This number tells you how many times do you pay to your average payable in a year. So how does decreasing accounts payable turnover means delaying the payment to your vendors? First you used to pay after 60 days, now you are paying after 90 days. Delaying, decreasing the accounts payable turnover. How would it affect the cash flow from financing activities? Payment to your accounts payable and vendors, it is not a financing activity, it's a part of operation. Payments to your vendors, payment to suppliers, it's a part of operating activity. It has no impact whatsoever on your financing cash flow. And is this a source of sustainable cash? Sustainability means that would it be fine if you keep on delaying the payments to your vendors? They will become angry. They might stop extending the credit. It will only make your relationship worse. So this is not a sustainable source of finance. Yes, buying goods on credit is a source of finance, but extending the payment to your vendor by delaying the payment, this is not sustainable action, because your vendor would refuse to sell you further if you make late payments. So that makes no impact. Is a sustainable source of finance? No. You can't delay the payment, so that makes B to be the correct option. Next, which of the following is not a category on the statement of cash flows? We have 3 categories: cash flow from operations, cash flow from investing activities, and cash flow from financing. operations financing, there is no activity as sales. It's a ridiculous response and ridiculous options, and that is the right answer, B. There is no such category. Next, if Jackson's Key Company issues common stock and money, of course, is received as a financing inflow and uses this cash to purchase fixed asset as an investment outflow, where would we show these? Of course, it's a financing inflow to be shown in the financing section, and we have used this money to purchase fixed assets. It's an investing outflow. So cash flow from financing activities would decrease. No. Cash flow from financing would increase. It's F plus. And cash flow from investing would decrease. I negative. So that makes B to be the correct option, and B it is. Next, a company's financial statement data for the most recent year include the following. The data has been given. What we are required to do based only on these numbers: cash flow from financing activities. Just focus on financing. Financing means issuing bond, financing inflow. What else? Issue of common stock, issuance of common stock, issuance of bonds. These are the only financing transactions, and both of these are inflow, so that gives you 70 to be the correct option. 70 it is. Speed, gentlemen. Speed and accuracy. Read the information carefully, extract the information, plug in the numbers in the formulas and arrangements, and get your answer. Alright, next, again, when you find a longer question, it's always recommended you look at what is required. We need cash flow for financing. That means any cash issue from shares, cash from share issue or bond issue, or any redemption of shares, or any payments of dividends. These are all financing inflows and outflows. Dividend paid, yes, it's a financing outflow. Common stock issued, it's a financing inflow. Equipment is investment. Bonds issued, it's a financing inflow. And the rest of these relates to operation. And that's all. That is all. And that's how you extract your information from the given data. Save your time, select the right option, and move on. A. 70. So when you read the requirement, that will provide you the right focus and tells you what you should be looking at. 13. Which of the following is not found in the financing cash flow part of the statement of cash flows? Dividends paid, it's a financing outflow. Change in long-term debt. If the long-term debt has changed, it means either you have repaid the debt, or you might have borrowed more funds, or you might have issued more bonds. So yes, it could be a financing inflow or a financing outflow. So yes, they are a part of financing. But change in retained earnings, it doesn't affect your financing cash flows. It relates to your operation. The results of operations eventually are dumped in retained earnings. Whatever your net profit or loss for the period, eventually it becomes part of your retained earnings. So C is the one we're looking for, and C it is. Next, again, a big question. Just look what we need. We need cash flow from operating activities using indirect method. Cash flow from operating indirect means we should start from net income. Here we go. That's net income. Increase in account receivables. Increase in account receivable over the period means our customer didn't pay. When they don't pay, it's an outflow. Decrease in inventory, it means we have sold our stock, and this reduction in inventory means it's an inflow. Depreciation is a non-cash expense, must be added. Decrease in accounts payable, indicating that you would have paid. When you pay, it's an outflow. Increase in wages payable, you have withheld your accounts payables, wages payable. Withholding your liability is effectively increasing your cash flows. Add this up. Decrease in deferred taxes. Most of the questions in your CFA have assumed erroneously, because CFAs are not professional accountants. We are. They do not know that deferred taxes could be in asset form and could be in liabilities. Deferred tax asset, deferred tax liability. But most of the question in cash flows, they have assumed deferred tax liability. So if there is a decrease in deferred tax, here it means it's deferred tax liability. It's assumed. So in decrease in liability, it's an outflow. When the liability has been settled, it has fallen, it represents an outflow. Right. So we have to find cash flow from operating activities only. Purchase of new equipment, it's investing outflow. Dividend payments explicitly is a financing outflow to be ignored. Just sum up all these 225 to this, deduct negative 55 plus 33 plus 65 negative 25, plus 15 and negative 10, and you should get the right answer. It's 248. Cash flow from operating activities is generating a positive figure of 248. A and A it is. Next, what do we need? Cash flow from financing. That's the focus, gentlemen. Financing cash flows. Okay, on January 1st, 1 million 5 years 10% annual interest bonds were issued. Clearly a financing inflow. For what? To cover industry's exchange for old equipment. The next part of the statement has totally reversed the idea. We have issued bond, but in return we did not receive cash. In fact, we acquired an old equipment. Rather, it's just acquiring an asset, and in consideration of payment, we have issued bonds. No cash is involved in this first transaction. Second, on June 30th, Favor paid 50,000 of interest to cover. Interest payment is cash flow from operating activities, an operating outflow, right? On July 1st, Cover returned the bonds to Favor in exchange of 1.5 par value 6% preferred stock. Bonds are being converted into preferred stock. No cash is changing hand. No cash is going in. No cash is going out. Ignore this. On December 31st, Favor paid preferred stock dividend 45. This payment of dividend is a financing outflow. Only this. This is the only financing outflow. That makes B to be the correct option, and B it is. Next, Darth Corporation most recent income statement shows net sales of this much. Darth's marginal tax rate is 40%. Total expenses 3,200, all of which were paid in cash. In addition, depreciation was reported as 800. A further examination of the most recent balance sheet reveals that the account receivables during the year increased by $1,000. The cash flow from operating activities reported by. The question is silent. Should we use the direct or indirect? When the question is silent, I always recommend to use indirect, because that's the method we are most conversant with, and it's easy to apply, because in indirect method there are certain adjustments. So where do we start from in indirect method? We need to start from net income, and we don't have net income. We can calculate. We have the net sales 6,000. From this next net sales, we have to deduct our operating expenses 3,200. We have to deduct the depreciation also, net 800. It means our net income before tax, I would say it's a profit before tax. It's $2,000. But don't forget, we have to pay tax at the rate of 40%. So payment of tax at the rate of 40% means you pay 800 as tax and you get 1,200 as a net income. That's the starting point. That's what we get to work on. Net income is 1,200. In this net income, we add a depreciation full as a non-cash expense. That's what the normal practice. Net income, add depreciation, other adjustments for working capital. What else do we need? We need to adjust this $1,000 representing increase in account receivables. Increase in account receivables mean they didn't pay. When they don't pay, effectively it's an outflow. So netting them all, 1,200 plus 800 less 1,000 should give you 1,000. So that makes B to be the correct option, and B it is. Next question, and again it's a big one. So instead of just reading the whole question and then ending up with the requirement, why don't we just see what is needed? Cash flow from investing activities, acquisition of assets, and that would come from this side. Equipment purchased, investment outflow. Bonds issue, financing. Fixed assets sold for 60. This fixed asset sold represents an investment inflow. Account receivables, inventory, accounts payables, wages, that's all. Just these two numbers, and that is just all. 10. 50 outflow, 60 inflow, and you get your answer. So reading the requirements saves a lot of time, and you need to really rush during exam because time is of the essence. Speed and accuracy, that's what you need to get through your level 1. 10. A, correct answer. Next. 18. To convert an indirect statement of cash flows to direct basis, what we do? In order to convert an indirect cash flow statement into direct, what we do? Reduce cost of goods sold. Cost of goods sold is already an outflow. We need to make adjustment in cost of goods sold. Reduce cost of goods sold by decrease in inventory. Now this is interesting. CGS itself is shown as a negative because it's an outflow. Decrease in an inventory over the period represents an inflow. Decrease in inventory is an inflow. So talking in the same terms as the information given in this option, reduce cost of goods sold by decrease in inventory. It means if one is negative, other is plus. They are in opposite direction. Correct? Correct. Reduce cost of goods sold by decrease in inventory means they are in opposite. If you take one negative, other will be positive. If you take one plus, other would be negative. Correct option. CGS is negative, and if there is decrease in inventory, it's an inflow to be added. If there has been an increase in inventory, it will be negative, negative, negative. Next, option B. Cost of goods sold, it's an outflow, CGS. Increase cost of goods sold by any depreciation that was included. No. This is wrong. He says CGS should be to be added with depreciation. Depreciation is a non-cash expense. It must be removed. If CGS has been taken as negative, depreciation must be adjusted. Whereas it says you have to increase CGS with depreciation. No, CGS is adjusted for depreciation. Depreciation is deducted. But here it says it's plus plus. It's not plus plus. It's negative plus. Last, reduce cost of goods sold, which we take as negative. CGS is negative. Reduce cost of goods sold by any decrease in accounts payable. Decrease in accounts payable is an outflow. If it's an outflow, we show it as a negative. So basically it's a negative negative. But here it says that you have to take CGS as positive, and from this you need to deduct decrease in payable in opposite direction, plus negative. But it should be combined. CGS, decrease in account payable is combined, not netted off. So both of these are incorrect option. Option B and C are incorrect. So important point to note down is that CGS considered as a negative, it's an outflow, and decrease in inventory effectively is an inflow. So it's negative plus, which is same as I have written here, negative and plus. But increase in CGS with the depreciation, this is wrong. Depreciation is a non-cash expense. It is removed from CGS, not added. In other words, if CGS has been taken negative, depreciation is taken as positive. And lastly, reduce CGS by decrease in accounts payable means CGS must exclude decrease in accounts payable. If we use our logic, we take CGS as negative because it's an expense. And decrease in accounts payable represents a reduction in your liability. It's a negative. It's a negative negative. Rather, they are combined, not netted. That is why B and C are incorrect. A is the right answer and A it is. Next, how would a stock split? Stock split means you have a larger stock and you divide it into smaller denominations. Like you have $100 stock and you split it down into 10 smaller denomination $10 stocks. It's a non-cash transaction. Splitting up a stock into smaller denomination or joining smaller denomination stocks into a larger one, it's a neither cash inflow nor cash outflow. There's nothing in it. A stock split would not be reported on the statement of cash flows because it is a non-cash event. It has no cash in and out. That's why A is the right answer and A it is. Next, an analyst contemplates. Contemplates means considering carefully. An analyst contemplates using the indirect method to create the projected statement of cash flows. She decides to research the differences between direct and indirect method. Which of the following statement is most accurate? Under the indirect method, depreciation must be added to net income because it's a non-cash expense. It's a 100% true statement. We don't need to look any further. In indirect approach, we add depreciation to the net income. Correct. Direct method, depreciation must be added to cash collections. No, depreciation is a non-cash expense. It is totally ignored in direct method. Indirect method. Indirect method, changes in accounts receivables are already included in net income. No, account receivable change is not reflected in income. Rather, changes in account receivable is adjusted in net income as working capital changes. This is also incorrect. So that makes A to be the correct option. A it is. The difference between cash flow from operating activities under direct method and cash flow under indirect method, whether you follow a direct approach or an indirect approach, your cash flow under both methods must be the same. The difference between them would be zero, because whether you use direct method of preparing cash flow from operations or indirect method, the net cash from operations under both methods must be same. If they are not same, you have made a mistake. So the difference between these two should always be zero. A. Next, here is, which of the following statements about accounting procedures and their impact on statement of cash flows is least valid? Is least valid. In other words, which of these statements is wrong? A. Cash flow from financing is higher over the life of a bond if a firm issues the bond at a premium. When a bond is issued at premium, let's say $120, at maturity it is redeemed at $100. And when you issue a bond at par, it is redeemed at par. Net impact is zero. But in this case, net is positive, 20. Now read the statement again. Cash flow from financing is higher over the life of a bond if a firm issues the bond at a premium. If the bond has been issued at a premium, the difference between premium and par would represent the net flow to financing activities. And if it has been issued at par, 100 bonds par has been redeemed at 100 par, net is zero. So if comparatively speaking, if we compare these two, cash flow from financing activities will have a higher cash flow if the bond has been issued at a premium and redeemed at par value. So this is a true statement. Statement A is true. Right? C. We will discuss B later. A company that finances through common stock issues may have the same cash flow from financing activities as a firm that issues debt. Let's say a company has raised $100,000 by issuing common stock. Another company has issued $100,000 by issuing bonds. It says that if the company has issued common stock or another company has issued bonds, they may have the same cash flow from operations. Yes. Why? Because interest paid on bonds, it is shown as a part of operating activities. And if a company doesn't pay dividend, because payment of dividend is not a compulsion, it is not an obligatory responsibility on the company to pay dividend. Dividend may not be paid for, like Apple Incorporated didn't pay dividend for consecutive 10 years. So if you have issued common stock and you don't pay the dividends, if you have issued the bonds of same amount, the cash flows from financing in both these can be the same. It is possible, perfectly possible. Then of course it has to be B. Why B? Now this needs little detailed scrutiny, detailed analysis. A non-profitable company that uses LIFO. In fact, the statement is wrong, because if you read the whole statement and if you remember the idea that a company that has made a profit, if a company adopts LIFO and if the prices are rising, if company uses LIFO, the prices are rising, you will charge your expensive costs, which are rising prices, to the CGS. If prices are rising, you will charge your expensive cost to CGS. Resultantly, your gross profit will fall and your net profit will fall and you pay less tax. But that is only possible if the company is profitable, because only the profitable company pays taxes. Non-profitable company gets some tax credits or some tax adjustments, right? So this is the wrong statement. If you cancel this non, then the statement will be correct. A profitable company that uses LIFO to account for inventory will have higher total cash flow than a profitable company that uses FIFO, because if the prices are rising, using LIFO will charge higher cost to your CGS. When CGS goes up, the profit goes down. When the profit goes down, you pay less tax. Hence, when you pay less taxes, comparatively with this company, you will have higher cash flows. Since this statement carried the word non, it totally made it invalid. because non-profit making companies do not pay taxes. So wrong. So this statement is the one that is wrong. You just have to understand by removing this non, reading it up, you will find this statement is not correct. Adding non to it will make it incorrect. That's the idea. So that's why B is the right answer. Detailed description is given. You can clarify your concepts further by reading through the given explanation. Next, question 23. What do we need? Cash flow, free cash flow to the firm. Do we have the format? Yes. This is how we can calculate free cash flow to the firm. We need NOPAT. NOPAT means net operating profit after tax. That has been given as 43.7 million. To this we need to add depreciation or amortization. We have 4.2 million as our depreciation. Effectively, these two combined give you cash flow from operating activities, right? Plus, we may have to make some adjustments for working capital also. So these two added, considered. Increase in account receivables. Now let us consider these. Instead of putting them in formula, take these numbers, because these numbers will tell whether you will be adding or deducting. Increase in account receivable over the period. They didn't pay you. It's an outflow. Must be deducted from these two. Decrease in accounts payable. If account payable have decreased over the period, that represents an outflow. You have paid them. Common stock, capital stock, it's a financing transaction. Again, sold equipment with book value 7 for 15 million. Selling an equipment at a gain of 8 million. This 8 million gain must be deducted from cash flow from operations, from net income. If you remember, loss on disposal is added, gain on disposal is deducted. So 7 million versus 15 million, 8 million gain, this gain must be deducted. First thing. Then you just look at it carefully. You have purchased a new equipment, 35 million must be deducted. At the same time, you have sold an old equipment for 15 million. So yes, there is a gain and loss impact must be taken care of as well. At the same time, selling this asset for 15 million, it's an outflow, it's an inflow for capital investments, capital expenditure, and here it's an outflow. Now, let's see what we're doing now. We have net income 43.7. To this we add depreciation 4.2. Increase in account receivables is an outflow 1.5. Decrease in accounts payable, you have paid them 2.3 negative. This gain, loss is added, gain is deducted from operating cash flows. I'm sure you remember that. Sold equipment, and this will fetch you 15 million, add 15 million. And from this, we purchase an equipment for 35 million, deduct 35. 16.1. So we need the one closest to 16 million. 16.1 we have, and it's 16 million. So remember, I have done these things. I have made the starting from net income. To this I have added depreciation, adjusted for capital expenditures. These are the two items of capital expenditure, and then I made some working capital adjustments, and which is to be added, which is to be deducted. You are well aware. So the point to remember that these are the three things: income, depreciation, capital expenditure, inflow, outflow, in other words net flow, and the adjustment for working capital. When I say working capital, it means account receivable increase, decrease, inventory increase, decrease, and accounts payable. And what to be added, what to be deducted, you must decide from the given information rather than using this negative sign. This will only tell you what are to be considered. Addition and subtraction is entirely upon your own understanding from the information. B it is. Again, determine the cash flow from investing activities. Investing means we have sold an equipment, investment inflow, purchase of land, investment outflow, and then there is nothing else. See, just focus what we need. Save your time. Plus 25, less 15, 10. Khalas. C and C it is. 10. Read the requirement, then scan the question, and then make sure you do it within the limited time, within the minimum time possible. Next, which of the following should be classified as cash flow from investing by Elegant Incorporated, which reports under the US GAAP? Cash flow from investing. Interest received by Elegant Incorporated. As we have already seen that interest received it is considered as a part of operating, not investing. Dividend received are also considered as a part of operating, not investing. Wrong. Elegant payment to purchase equipment to be used in its business. Yes. Purchase of equipment, it's an investing outflow. Investing outflows. So that makes C to be the correct option. We were looking for investing cash flows. So C is the investing cash outflow and C is the right answer. Again, a bigger question. What is the right approach? We need to find out the cash flows related to investing and financing. We just need to find these numbers. Investing inflows, outflows, financing inflows and outflows. Gain is not a part of it. Proceed from sale of equipment, it's an investment inflow. Purchase of Zip company bonds, you have purchased bonds of another company, again it's an investing outflow. Amortization of bond discount, it's an adjustment in net income. Ignore this. Dividends paid, it's a financing outflow. Financing outflow. Proceeds from sale of treasury stock, you held some stock of your own company which you previously purchased from the open market. Now you have sold them. So this is a financing inflow. We just need to net them up. It's negative 170 for investing and it's going to be negative 75 plus 38. It's negative 37. Right? So it's 170 and 37. There is some mistake of sign, but nonetheless that's the right answer. Investing 170, financing 37, and both are negative. They should have put a sign, but I think that's the right answer. See, 170 and 37 is the right answer. Maybe these two signs are some here skipped to this position. See, 170 and 37. Okay. Depreciation expense would be classified as what? It is not an investing activity. It is not an operating cash flow. Rather, it's an adjustment in net income. It has no cash flow impact. Since it has no cash flow impact, that's why it is reversed. It is added back to net income because it was previously deducted in arriving at net income. So we have to add it back. So that's why B is the right answer. Next. Consider the following statements. Which of these statements regarding common size cash flow statement is correct or are correct? Common size cash flow statements can be prepared two ways. One approach to presenting a common size cash flow statement is to express each inflow of cash as a percentage of total cash inflow and each outflow of cash as a percentage of total cash outflows. This is one of the valid formats of preparing common size cash flow statement. That is, each cash inflow as a percentage of total cash inflows and each cash outflow as a percentage of total cash outflows for comparative purposes. Perfectly valid statement. Statement 2. Expressing each line item of cash flow statement as a percentage of revenue is useful in forecasting the future cash flows for the company. We can take revenue as our base and we can express all the elements in cash flow statement as a percentage of revenue. This is also one of the acceptable format of drawing up common size cash flow statement. If you've read your theory, you would know. So these are the two allowed and both of these are correct. Both are correct statement. Both are allowed formats of preparing common size cash flow statement. Next, which of the following items would least likely be included in the cash flow from financing? Cash flow from financing, least likely. Purchase of treasury stock, it's a financing outflow. Dividend paid to shareholders, it's a financing outflow. Of course, both of them are part of financing. Gain on sale of stock of a subsidiary, it's an investment activity. Gain is deducted from your net income and it is shown as a part of investment inflow. This is not a financing activity. A is not a financing inflow or outflow. A should be the right answer and A it is. Next, using the direct method, calculate the cash provided or used by operating activities. A very, very good question. It's a direct method and just keep your minds open. For 2005, we need to draw up the cash flow from operating activities using direct method. It all starts with sales. Sales is an inflow. Cost of goods sold, it's an outflow. Interest paid during the period, it's an outflow. Current income taxes paid, it's an outflow. Account receivables, they have decreased over the period. A good thing, a decrease in account receivable over the period represents an inflow of the difference between these two, $500,000. Decrease in account receivable is an inflow. Your inventory balance is going up by $600,000. So increase in inventory is considered as an outflow. Now here is a question that should be asked and I should answer. What? So while constructing cash flow from operating activities using direct method, if we have been given the purchases, yes, we don't need to consider inventory. That's an important point. If you have been given the purchase figure, note that no adjustment for inventories is necessary because purchases are given, right? That was the point. Since in this question we have been given CGS, we haven't been given the net purchase, so we have to consider the impact of inventory. Since inventory balance has gone up, it represents an outflow. Property, plant and equipment, it has nothing to do with the direct method. Accounts payable have increased. If they have increased, representing we didn't pay them, by not paying them effectively, we have increased our cash flow from operations. Accounts payable have gone up by 400,000. Effectively, it's an inflow. Long-term debt is not operating cash flows. Common stock is financing. So just adding these all, 21 million, less 15 million, less 1 million, less 1 million, add 0.5 million, less 0.6 million, and add 0.4 million gives you 4.3 million of cash flow from operating activities using the direct method, and that is the reason we have A to be the correct option. Next, it's a good one. Murray Company reported the following revenues and expenses for the year. We need cash collections and cash payments as a basis for the preparation of cash flow from operating activities using direct method. Cash inflows and outflows. A very good question indeed. So what are the sources of cash inflow? Sales revenue. It's outflow, outflow, outflow. Depreciation is not a cash transaction. This is revenue. Wages payable, insurance, interest, and depreciation to be ignored. All right. Now, sales revenue is $200,000 positive. Unearned revenue means the revenue which you have received but which you haven't yet earned. Unearned revenue has increased. It means you have received more money but you haven't yet earned. How much money has you received more? 15.6 less 13.2. 2.4, that is 2,400. This 2,400 is the money you have received over the period in the form of unearned revenue, but you haven't yet earned. It's a part of revenue. So it will be 202,400 as your inflows. That's either A or B. Let us see the outflows. 89, yes, 17, and interest expense. Now look at this, what we will do here, one by one. Wages payable, they have decreased over the period, means we would have paid this. Wages payable has decreased over the period by how much? By 1,200. So this is effectively an outflow. Prepaid insurance is an asset. We have created this asset, current asset. We would have paid this amount. That's why we have a prepaid insurance account showing 1,200. It's an outflow. Interest payable was 1,600 at the start and now it's just 500. We would have paid how much? 1,100. Now, these are our outflows. 89,000, negative 89,000, negative 17,000, negative 10,400, negative 1,200, negative 1,200, and negative 1,100. It gives you 119,900. So your cash collections are 202,400 and your cash expenses are 119,900. That makes B to be the correct option, and B it is. Next, under the US GAAP, cash flow from operating activities. Question is silent. What information do we have? Net income isn't given, so we have to use the direct method. There is no way. Cash paid to suppliers for the purchase of merchandise, that's outflow. Cash received from customers, inflow. It is not operating cash flows. Dividends paid is financing. Cash received from issuance of preferred stock, financing. Interest received on short-term investments, yes, it's in the US GAAP considered as an operating inflow. Wages paid, outflow. Repayment of bank loan, it's a financing outflow, not to be considered here. And cash from sale of land, it's an investing outflow. So just add these up. Negative 5,000 plus 14,000 plus 1,000 less 4,000 gives you a total of 6,000 positive. That is the net cash generated by operations, and that should be the right answer, and right answer it is. Which of the following is least likely a cash flow in the calculation of cash flow from operating activities? Least likely. In operations. Interest paid, it's an operating outflow. Dividend received is an operating inflow. But dividend paid explicitly is considered as a financing outflow. That's why A is not and cannot be an operating cash flow. A it is. Next, consider the following statements, and which of these arguments support the use of indirect method for the presenting cash flows from operating activities in the cash flow statement. First, the indirect method presents firm's operating cash receipts and payments and is thus more consistent with the objectives of cash flow statement. It is wrong. It is the direct method that presents cash receipts and cash payments from operations. Indirect method starts from net income and makes some adjustments for non-cash transactions and working capital changes. Wrong statement. 2. The indirect method provides more information than the direct method. Incorrect. Incorrect. Direct method is preferred not only under IFRS IAS 7, it is also preferred under the US GAAP. Direct method is preferred by IFRS, that is the IASB, International Accounting Standard Board, and it is also preferred by FASB, US standard setters. So they prefer direct method, not indirect. So both these statements are incorrect. Neither argument is correct. That's C. This is a very beautiful question, and we must do this under both methods, direct method as well as indirect, so as to highlight the difference between these two. So very nice question, I must say. A firm has net sales of 3,500, earning after tax is 1,000, depreciation expense is 500, cost of goods sold is 1,500, cash taxes are 500, inventory decreased by 100, account receivable increased by 300. What is the firm's cash flow from operations? Question is silent, but we can play with the question. We can do under both methods. We can do by direct method as well as indirect method. How do we do by direct method? Under the direct method, we have this inflow 3,500. It's the money received from cash sales. From this, we need to deduct expenses. We need to deduct the CGS. CGS is 1,500, right? So simply you have to take the inflows and outflows separately and net them off. So 3,500 represents the inflow from sales, 1,500 represents CGS. Now look at this. Depreciation won't be considered in direct method, remember. Cash taxes, yes, it's a payment, must be deducted. $500 must be deducted. Inventory decreased by 100. Now this is interesting. We have been given CGS. We are using direct method. So decrease in inventory effectively represents an inflow, 100. Remember, when the purchases are given, then we ignore changes in inventory. Since we have been given CGS, we must consider the change in inventory in direct method. So inventory decrease is an inflow, right? What else? Account receivable increased. Increase in account receivable, it's an outflow. Increase in account receivable means they didn't pay us, it's an outflow. So let us net this off. We should get the result using direct method. 3,500 less 1,500 less 500 less 100 less 300. It's 1,300. If everything is fine, we should get the same result using indirect method. What is the starting point of indirect method? We need to find first the net income. How do we find the net income? We take sales. From sales, we deduct CGS, or why don't we just take earning after tax, which has already been given? We can start from here. Earning after tax or net income, it is 1,000. To this net income, we add non-cash expenses, 500, that is the depreciation amount, right? Again, changes in inventory. Inventory decrease is an inflow, and change in account receivable increase is an outflow. There is nothing else that you can take. CGS has already been considered. Expenses have already been considered. So if you just net off this figure, 1,500, 16, again 1,300. So under both methods, your cash flows must be the same if you have used the right approach. Question 38. Galaxy Incorporated US GAAP balance sheet as of December 31st, 2004 included in the following information in dollars. Opening balance sheet extract is also given. Closing balance sheet extract is given. We have an opening, closing accounts payable, dividends payable, common stock and retained earnings. Galaxy net income in 2004 was $800,000. What was Galaxy's cash flow from financing in 2004? Cash flow from financing could either be out of stock issue, there is no stock issue, then it must be from dividend payments made during the period. So we can't directly calculate the dividend paid until we first draw up the retained earnings account. So we need to draw up first the retained earnings account. Retained earnings, RE, has an opening balance of 700,000, closing balance of 1 million, all the numbers are in thousands. And the dividend payables, DP, it's 200,000 at the beginning and 300,000 at the end. Okay. Whatever we earn, it is transferred to retained earnings. In other words, your net income is close to retained earnings. So this 800,000 would appear at this side. Right. Now, 700,000 is the opening balance of retained earning, 800 is the income for the period, and after distribution we are left with 1,000. How much have we declared as dividend? 700 plus 800, 500. This has been declared as dividend. Whenever dividend is declared, the entry that we pass with debit retained earning with 500,000, credit dividend payable 500,000. So this must have been credited in dividend payable, right? Now, opening dividend payable declared during the period, we should have paid 700. 300 is still payable at the end of the year. It means what we have paid, the difference between these two, that is 400,000. This is the dividend paid during the period. That makes B to be the correct option, and B it is. Drawing up the accounts will help you solve questions like these. Next, it says which of the following transactions would least likely be reported in the cash flow statement as investing cash flows. Sale of held to maturity securities, it's an investing cash flow. Purchase of plant and equipment used in manufacturing process with financing provided by the seller, it's a non-cash acquisition of an asset. It does not affect your investing or financing cash flow. It is reported outside the cash flow statement in the footnotes. Principal payment received from the loan made to others. We have made loans to someone and now we are collecting them a loan back. It's an investing inflow. So A and C are investing cash flows. B is a non-cash investing, non-cash financing transaction. It's a non-cash investing and financing because we have used funding, financing to acquire an asset. So it's a non-cash investing as well as non-cash financing. So that makes B to be the right option because it is not an investing inflow or outflow. It's a non-cash investing, non-cash financing because the asset we acquired is an investing, but it's a non-cash investing, but it was financed through a loan from seller. It's a financing aspect as well, but it's neither cash inflow nor outflow. It's a non-cash investing and financing. So B is the right answer. Next, the cash flow from operations. Net income is given. What we should do, net income, certain adjustments. What adjustments? We need to add back depreciation And what else? Is there any gain or loss? Income from, there is nothing else. That's all. So you will take your net income, to this add your depreciation. And I don't think so there is anything else, gain or loss. Okay. Then you come to this side. Over the period, your account receivables have increased by 10. Account receivable increase mean it's an outflow, minus 10. Inventories have reduced by 20. It's an inflow. Depreciation has already been taken care of. Accounts payable, they have increased over the period. It means we have delayed making payment to them, plus 50. Long-term debt is not common stock retained. That's all. These are all the adjustments needed. So 100 is for net income, 50 for depreciation, less 10, plus 20, and plus 50 gives you a total of 210. So cash flow from operating activities is 210. That's C. C is the right answer. All right, moving on. What is the cash flow from operations? Cash flow from operating activities, we need to see, do we have net income? Yes, that's our starting point. Net income is our starting point. So taking net income as our starting point, we need to make certain adjustments. Specifically, depreciation is to be added back. Gain on disposal is deducted. These are the two adjustments from within the net profit and loss account or income statement. Dividend paid financing, common stock financing, equipment purchase investing, bonus issued financing. Fixed assets sold, original cost 100 with accumulated debt 70, sold for 60. Gain has already been incorporated. No need to take this again. Account receivable decrease, inflow. Inventories decrease, reduction in inventory, inflow. Accounts payable increased, we didn't pay to our vendors, good for us, inflow. Wages payable decrease, decrease in liability is an outflow. So take 96 as your net income. To this add gain, deduct gain, add depreciation, add 30, 20, 20 and deduct 10. 156. Cash flow from operations is 156, so that makes A to be the correct option. 8 is. Again, now, next question, we have been given a cash flow statement. It has operating activities, cash flows, investing and financing, and the total cash change over the period. What is needed? Thibault's reinvestment ratio for this period. Reinvestment ratio is a very simple calculation. Reinvestment ratio is simply the cash flow provided by the operating activities divided by the cash used up in acquiring long-term assets. Cash flow in acquiring long-lived assets, because in the US, long-term or non-current assets are called long-lived assets. Okay, so cash flow from operating activities is a positive number, 1300 euros, and interest received, interest dividend received, no. Cash paid for plant and equipment, we paid $2,600 for the acquisition of long-lived assets. So cash flow from operating activities divided by cash flow used up in acquiring long-lived assets. This ratio is called the reinvestment ratio. If you simplify, it will be 0.5. So that makes A to be the correct option, and A it is. Next, the company's cash flow from financing. Financing means any dividend paid, share issued, loan received or loan repaid, net sales, no, 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 inventory, no, sale of common stock, inflow, repayment of debt, financing outflow, depreciation, no, net, just two items, just these two items, plus 100, 10, less than 10, 90. That makes A to be the correct option. 8 is next. Holden Company's fixed assets footnote included the following. What do we need? Cash flow from investing activities for the year ended 2007. Cash flow from investment. Okay. Sold machinery for a gain of $100,000. The machinery had an original cost of $500 and an accumulated depreciation 240. It means it had a book value of 260. We sold an item that had a book value at a gain of $100,000. It means we would have sold it for 360 because 260,000 is the book value. We sold it at a gain of $100,000. It means this is what we would have received as a disposal inflow. Okay. At the end of the year, to next 7, Holden purchased machinery at a cost of 1 million. It's a 1 million outflow. But remember, it says we only paid 400,000. That's an interesting point. We acquired a machinery. The cost of machine is 1 million, but we paid only this much. The balance was financed by the seller at 8% interest. So we just paid this much amount. So 360 was inflow for the disposal of the asset. 400,000 is the outflow for the acquisition of a new asset. The net flow, depreciation has nothing to do with it. So the net flow is a negative 40,000 outflow, that is B. B it is. A company prepares its financial statements under the International Financial Reporting Standards. The cash flow statement will classify interest paid as either. We have discussed and seen in much more detail that under the US GAAP, interest payment is considered as a part of operating section, whereas under the IFRS, it might be considered as an operating or a financing cash flow. Since it says it under the IFRS cash flow is under either operating. For interest payment is either shown as a part of operating cash flows or financing. But under the US GAAP, it's an operating section cash flow. So that means under IFRS, it is either operating or a financing cash flow, so that it makes C to be the correct option. C it is. Okay. Which of the following best describes a ratio that measures a firm's ability to acquire long-lived assets with the cash flow from operations? Of course, it's a reinvestment ratio. We have just seen reinvestment ratio is cash flow from operating activities upon cash invested in long-lived assets. We've just seen that. So this is the ratio that measures the ability of the firm to acquire fixed assets with operating cash flow, either B or C. And second is a performance ratio. A performance ratio. When you say performance, you're talking about income statement items or the income statement, net income most probably, precisely. So it's cash to income ratio. Yes. But if you look to the left side, investing and financing ratio, no. Ability of a firm to acquire long-lived assets using operating cash flow is calculated using reinvestment ratio. So that makes A to be an incorrect option. Yes, cash to income ratio makes sense. And it has to be then combined with the reinvestment ratio. Now, these two ratios exactly fit the bill. This ratio helps us assess the company's ability to acquire assets from its operating cash flows. And this is the performance-related cash flows. Cash as a percentage of income. How much cash has been generated from income. So that makes C to be the correct option. C it is. The following information is from the balance sheet of Silverstone Company. We have been given the net income for the period, $8,000. What we are required to do, use the indirect method, calculate the cash flow from operations for Sylvester Company as on 31st of May 2000 X5. Okay, we have the starting point, net income is given. Over the period, inventory has, over the month, 1st of May to 31st of May. So inventory has fallen, it would have resulted in an inflow. Your prepaid expenses have increased, it would have resulted in an outflow. Accumulated depreciation, the difference indicates it's the depreciation charge over the period, 175. Depreciation is added back. Accounts payable, it has gone up over the period by 200. We have delayed making the payment, effectively representing an inflow. So simplify these all. $8,000. To this add 250. Deduct 500 plus 175 plus 200. So total of 8125. This is the cash generated from operating activity. So that makes C to be the correct option. C it is. Next question, question number 48. Which of the following does not represent a cash flow relating to operating activities? Interest paid to bondholders is an operating outflow. Cash received from customers is an operating inflow under direct method. But dividend paid, it is explicitly a cash flow from financing activities under the US GAAP. When the question is silent, you must take it for granted that it is to be solved under the US GAAP. Question is silent, there is no mentioning of IFRS or US GAAP. So it is US GAAP if the question is silent, and under the US GAAP, dividend paid to the stockholders is cash flow from financing. So this is not an operating cash flow, hence that's our right answer. B is the right answer. Next, Jody Lean, small business consultant, is currently working with RJ Landscaping, a sole proprietorship. She is trying to educate the owner on the importance of monitoring cash flows. Operating information as of the end of the month, most recent month, appears below. All the information given. What do we need? Using this information and the US GAAP, what is the cash flow from operations for the month? All right. Now, it means we have to use the direct method. Under the direct method, what we do, take all the operating cash inflows and outflows. Truck investment, cash for salaries outflow, cash flow from customers inflow. Depreciation is not to be considered under the direct method. Interest on bank loan of credit on line of credit outflow. Interest paid is an operating outflow. Cash paid to supplier, operating outflow. Other cash expenses including rent, outflow. That's all. You simply have to add it up all. So it's negative 17 plus 45, negative 1000, negative 22, negative 6300. It's a negative 1300. Cash flow from operating activities is a negative 1300. So that makes B to be the correct option, and B it is. Next, which of the following items would not be included in cash flow from investing? Buying or selling a building, it is investing, inflow and outflow. Proceed related to acquisition, when you purchase a company, of course it's an investment. Or when you sell, it's an investment, inflow or outflow. So B and C are investment, inflow, outflow. Selling stock of a company, when you sell stock of your company, preferred or ordinary, it's a financing inflow. So A is not an investing, rather it's a financing inflow. That's why A is the right answer, and A it is. Next, which of the following items is least appropriately described as a liability? As a liability arising from operating activities for a non-financial company, not a bank, not a financial institution, maybe a trading organization. Cash advances from customers, it's an operating liability, liability related to your operations. Trade payables, it's a liability related to your operations, right? A and B are liability arising from an operating activity. But the current portion of long-term debt, a part of the debt that is payable in the current period, this is clearly a result of financing arrangements, of financing activity outflow. C is the right answer. Next, again a bigger question and a good one, I must say, a very good question. Calculate Maverick's cost of goods sold and cash paid to supplier. Cost of goods sold is not a big deal. We have been doing it for the last many ages. Beginning stock plus purchases minus ending. So it's 2000 plus 8.1, 8100 less 2.3, that is ending stock. It's 7800. So cost of goods sold is 7800. So that makes either B or D to be the correct option. Now this is something that we need to do in a very proactive manner. Cash paid to suppliers. There are two ways we can do it. You need to focus, gentlemen. It's a point that most of you get confused. There are two ways we can do it. Cash paid to suppliers. The first thing we can take is take simply purchases, that is negative 8100, and see there has been a decrease in accounts payable. Purchase itself is a negative number representing an outflow from operations. If the account payables have also fallen by 400, it means we would have paid. So the cash paid to your supplier is $8,500. This is the one way of doing it. You take purchases and you take the changes in your accounts payable. This is one way of, you get the right answer. It's C. There is another way. You take CGS, which is right here, 7,800. When you take CGS, you have to take two things: changes in accounts payable and changes in your stock or in your inventory. These two things. So either you take purchases and account payables, it will give you the cash paid to suppliers. Or if you start from CGS, then you have to make adjustments for accounts payable and inventory both, then you will get the right answer. Now let's see that. Account payable has fallen over the period. The reduction in account payable means it's an outflow. By how much? 1,600 to 1,200, 400. Inventories have gone up from 2,000 to 2,300. Increase in an inventory item means it's an outflow. Combining these all will give you the exact same answer. So that's a very important point to remember. Cash paid to suppliers can either be calculated through purchases and account payable or CGS, account payable and inventory. So it must be remembered, we must not confuse these two. So we got the answer 7,885. That makes C to be the correct option, and C it is. Next, the correct set of cash flows, and as the table would help us again, the correct set of cash flow treatment as they relate to interest paid according to the US generally accepted accounting principle. Interest paid is operating cash flow, but under the IFRS it may be considered as an operating or a financing cash flow. So that makes CFO, CFO, CFF. B. Again, in converting a statement of cash flows from the indirect to the direct method, which of the following adjustments should be made for a decrease in unearned revenue? Decrease in unearned revenue. First of all, since you are moving from indirect to direct, we have already considered sales as our inflow. Okay. When our unearned revenue falls, what is unearned revenue? Unearned revenue is a liability. Unearned revenue is a revenue received in advance. It's a liability. A reduction in liability, just like a reduction in account payable, is an outflow. So this is the way to remember. Decrease in unearned revenue is like a reduction in a liability. A reduction in a liability means outflow. So remember, decrease in unearned revenue is like a reduction in liability. A reduction in liability is like an outflow. Even there is no cash outflow for this, because unearned revenue means that there was an unearned revenue which has not been realized in the income, right? So effectively it's a liability. So decrease in liability we have always been taking as an outflow. So this decrease in unearned revenue must be subtracted from sales. It must be subtracted from cash collection from customers. So that makes either A or B to be the correct option. Next. And when calculating cash collected from customers and for an inventory write down, when calculating cash payment to suppliers. Now, let's say we have made a payment to our suppliers of $1,000, right? Our stock has fallen from $100 to $70, and this reduction has been just because we wrote off an item of inventory because its market value fell than the cost. We had to write this stock off. Apparently, we have so far been considering a reduction in inventory as an inflow, but this reduction, gentlemen, is not an inflow. A reduction in an inventory figure from 100 to 70 has been caused by an inventory write-off. Normally, reduction in inventory is an inflow, but this reduction is because of inventory write-off. So we won't be considering it as an inflow. It has to be reduced from the total amounts paid to suppliers effectively. So subtract cash paid to supplier. It should be shown as a subtraction from the cash payment to suppliers. Apparently, from the numbers, it would appear that we have paid 1,000 to our suppliers, but effectively out of this, reduction of 30 has been caused by the inventory write-off. So we need to remove this effect from cash paid to suppliers so as to give it the right number. So we must subtract decrease in unearned revenue from sales or collection from customers, and we must reduce inventory write-off from cash paid to suppliers. So that makes A to be the correct option, and A it is. Next, an increase in notes payable. Increase in notes payable would be classified as what? Notes payable is a liability. It can't be investing. It has a cash flow impact because when you issue notes payable, it will result in inflows. It's a financing inflow. Issuance of bonds, issuance of notes, issuance of debentures, issuance of common or preferred stock, it's a financing cash flow. B it is. Determine the cash flow from financing given the following table. Cash flow from financing. Cash dividend paid, financing. Sale of equipment, no. Net income, no. Purchase of land, investing. Increase in accounts payable, operating. Sale of preferred stock, financing. Increase in deferred taxes, operating. Profit on sale of equipment. So it means only these two. 25 plus 30 negative. So it's a net of these two, negative 5. B is the right answer. Which balance sheet accounts are most closely related to operating activities on a firm's cash flow statement? Operating activities. Operating activity means working capital. Non-current assets relate to investment inflow outflow. Equity and non-current liabilities, they represent financing inflow outflow. But working capital changes, of course, they are very much part of your operating inflows and outflows. So that makes B to be the correct option. Next, a good question indeed. Capital Corp's activities in the year 2005 included the following. At the beginning of the year, Capital purchased a cargo plane for aviation partners for 10 million in exchange for 2 million cash. So on acquisition of this plane, we had to pay 10 million, but the 10 million was paid partly out of cash, partly in the form of stock, and partly in the form of preferred stock. So the cash amount that has been paid to acquire the asset is $2 million. Okay. Interest paid 150 on bonds. Dividends 250 were paid on the preferred stock. Of course, it's a financing outflow. What is needed? We need to find out cash flow from investment related activities. This is investing cash outflow. Interest payment is not investing. Dividend payment, of course, not investing, is a financing outflow. At the end of the year, the cargo plane was sold for 12 million to Standard Company. Proceeds from the sale were used to pay whatever we did later is different. We have received this 12 million. So this is basically an inflow. This was an acquisition outflow. This was the disposal inflow. So the net is 10 million positive. So that makes B to be the correct option, and B it is. Next, according to the US Generally Accepted Accounting Principles, again this table will help us, and IFRS, dividend paid to be treated in what way? Dividend paid, it is considered as a financing outflow under the US GAAP, operating or financing under IFRS. So that makes cash flow from financing, yes, cash flow from financing or operating. B, we've done this question many times. Next one, question 60. Convenience Travel Corporation's financial information for the year ended December 31st, 2004 included the following. Property, plant and equipment 15 million. Accumulated depreciation 9 million. The only asset owned by Convenience Travel in 2005 was a corporate jet airplane. The airplane was being depreciated over a 15 years period on a straight line basis at a rate of $1 million per year. This is the depreciation expense every year. On December 31st, 2005, Convenience Travel sold the airplane for 10 million cash. Net income for the year ended December 31st, 2005 was 12 million. Based on the above information and ignoring taxes, what is the cash flow from operations? We have net income. We should take this as a starting point. Net income was $12 million. Okay. Next step, how much was gain or loss on disposal? If you just look at this information, we charge depreciation 1 million every year. If 9 million was the opening balance of accumulated depreciation, so additional charge of 1 million this year would make a total balance in accumulated depreciation of 10 million. This is the original book value or historical cost. This is the depreciation charge so far. It means the net book value is $5 million. If this asset has a book value of $5 million and it is being sold for $10 million, clearly tells us that there has been a gain of $5 million. Because the book value is 5 million, we are selling it for 10 million. It means 5 million represents the gain over the period. This must be deducted. But we must not forget the depreciation charge for the period must be added. What was the depreciation charge? It was 1 million. So this is net income. This 5 million is the gain on disposal. How did we calculate? 15 million was the historical cost. 9 plus 1 million depreciation, 10 million was the accumulated depreciation. Net book value was 5. The asset was sold for 10 million. So 5 million is gain, that is to be deducted. Depreciation that we charge this year to make it 9 million to 10 million, this must be added back. So netting it off should give us 13 less 5, that is 8 million. So it means cash flow from operating activities is 8 million. So that makes B to be the correct option. Again, a bigger question. It says cash flow from operations. You should always look for net income. See any adjustment for depreciation or any gain. Yes, depreciation is to be added back, gain to be deducted. These two items noted. Account receivable over the period has increased, outflow 4 million. Inventory has also, it has decreased by 2 million, or it's an inflow. Accounts payable, they have gone up by 5 million. We have delayed making the payments. Effectively, it's an inflow. And I don't think so there is anything else. So take these three items starting with the net income of 10, adding back depreciation 22, deducting gain 6, then negative 4 plus 2 plus 5 gives you a total of 29. This is the cash flow from operations. So 29, B is the right answer. B it is. Next, to convert an indirect statement of cash flows to a direct basis, the analyst should do what? Add decrease in account receivables to net sales. Net sales is an inflow, as we have already agreed. If there is a decrease in account receivable over the period, decrease in account receivables represent an inflow. It's a perfectly correctly worded statement. Add decrease in account receivable to net sales to arrive at the cash flow from operations related to your customers. Correct option, need no further. A is the right answer. Given the following information, what is the adjustment to net income when calculating cash flow from operations using indirect method? Increase in accounts payable means we delayed the payment, it's added. Operating minded, cash flow from operations. Sold one truck, investing. Paid dividends, financing. Depreciation, since we are using the indirect method, depreciation expense must be added full. Increase in your stock over the period represents an outflow. So it's 25 plus 100 less 20. So total of net adjustment of plus 105. So that makes A to be the correct option. A it is. When using indirect method for computing cash flow from operating activities, a change in accounts payable will require which of the following? Change in accounts payable. If account payable have fallen over the period, it's an outflow. If an account payable have increased over the period, it's an inflow. Let us find this arrangement. A negative adjustment, this one, to net income when accounts payable increase or decrease. We have just seen if there is a decrease in accounts payable, as you can see, it's an outflow. Decrease is negative, not positive. Decrease in accounts payable is negative, not positive. That makes this incorrect statement. A negative adjustment to net income regardless whether accounts payable increase or decrease. This is totally ridiculous. Account payable increase is treated differently, decrease is treated differently. This is the right statement. If account payable have decreased over the period, it is deducted, negative. If account payable have increased over the period, it is added. Now we have added, negative, decrease. C is correctly worded. That makes C to be the correct option. Frix Limited is a gold mining company headquartered in Indonesia with operations throughout the world. Frix reports under IFRS. Under IFRS, we don't have the table here. When subsidiaries located in United States and Canada pay dividends to the Indonesian parent company, Frix may classify the dividends. Frix is a parent company. It receives dividends from its subsidiaries. These subsidiaries are located in Canada and other countries. How this dividend received be treated under the IFRS? IFRS is a little flexible. IFRS gives you the option either to treat it as an operating activity or investing. But under the US GAAP, it is considered as a part of operations. Nonetheless, IFRS says it A, so it's A in this case. A is the right answer. Next, a common size cash flow statement. Forget about what are the options. Common size cash flow statements have just two options, two alternatives or two formats. Either we express the common size cash flow statement as a percentage of revenue. This is the first allowed alternative. And second one, every outflow as a percentage of total outflow and every inflow as a percentage of total inflow. These are the two methods we use in the common size cash flow statement. So common size cash flow statement is least likely to provide payment to employees as a percentage of what? Payment to employees can either be given as a percentage of revenue or as a percentage of total outflows. So, right? So it could be either revenue for the period or the total cash outflow for the period, but there is no way we take it as a percentage of operating cash flow for the period. These are just the two allowed or two normally used methods. There are two formats for common size cash flow statement, expressing each type of outflow as a percentage of total outflow or as a percentage of total revenue. 67. An analyst is considering carefully using the indirect method to create the projected statement of cash flows. Indirect method. She decides to research the differences between direct and indirect method. Which of the following is least likely a component of the statement of cash flow under the direct method? Payment of dividends come under both direct and indirect. Property, plant and equipment come both under the direct and indirect. But net income is reported under the indirect method for adjustments, but under direct method we don't have net income. That's the difference. So net income is available in operating activities in indirect method, but not under the direct method. That's the difference. B. That's the reason, the right answer. Next. Pacific Incorporated financial information includes the following, with change referring to difference from the prior year. We have the net income. Changes in accounts payable, receivables have been given plus and minus indicating whether they have increased or decreased over the period. Please do not get confused with these positive or negative signs. We have to use our own established logic. Forget about this plus sign. Change in account receivable. If account receivable has over the period increased representing an outflow, I am going to deduct this. Increase in account receivable, they didn't pay me, it's an outflow. This positive sign can confuse me. Changes in accounts payable. If account payables have increased over the period, it means I have delayed making the payment to them. So this plus 1 will be plus 1 in my understanding. If the stock has gone up over the period, increase in inventory is positive. Increase in inventory means money is being spent on acquisition of inventory. It's an outflow. So it will be negative 5. Loss on sale of equipment. Loss, you already know. Gain is deducted, loss added. Even it's negative, but we know loss is to be added in net income. Gain on sale of real estate. If it's gain, you need to deduct this. Retained earnings and dividends, they have nothing to do with it. Now you just can simplify this. 27, negative 4, plus 1, negative 5, plus 8, negative 4 gives you a total of $23 million. That is the cash flow from operations, and that makes C to be the correct option, and C it is. 69. The only section of the statement of cash flows that must be adjusted to convert a statement of cash flows from indirect to direct. Only section that you need to convert is the cash flow from operating activities. Rest of it, remember, because you have two methods, direct method and indirect method. Cash flow from operating activities are calculated differently in both methods, but cash flow from investment, they are the same under both methods. Cash flow from financing, they are the same. So the difference is cash flow from operating activities needs to be adjusted from converting from indirect to direct. A is the right answer, so that makes option A. What is the difference between the direct and indirect method of calculating cash flow from operations? The direct method starts with sales, follows cash as if it flows through the income statement. Correct. Starting with cash, you add and less certain inflows and outflows. That's the direct method. So far, so good. Correct. While in the indirect method, we start with the net income. We adjust for non-cash charges like depreciation, like amortization, like losses on disposal. Perfect. We need to look low further. A is the right answer. A it is. 71. Which of the following would not be component of cash flow from investing? Purchase of equipment, investing outflow. Sale of land, investing inflow. But dividend paid, it's a financing outflow. So clearly C is the option that is not an investing cash flow. C it is. When the US company pays dividends to stockholders, look no further, it's a financing outflow. Which type of cash flow does it represent? Financing. C. What is the impact on accounts receivable if sale exceeds cash collection? And this is an interesting and a question that requires little thinking before we give the answer. What is the impact on accounts receivable if sale exceeds cash collections? We have sold more, but cash was collected $700. Then what has happened? The remaining $300 hasn't been paid. That would have resulted in increase in account receivable. What is the impact on account receivable if sale exceeds cash collection? You have sold more, collected less money. What you did not collect is reflected in the higher account receivable. Right? And what is the impact on accounts payable if the cash paid to supplier exceeds purchases? We have paid more cash to our suppliers, where we have made the purchase for just maybe 900. We have paid more, purchased less. It would have resulted in decrease in accounts payable. Right? So it says both accounts payable and accounts receivables will increase. Wrong. Account receivable increase, accounts payable will fall. Only accounts payable will increase. No. Accounts payable will fall. Only account receivable will increase. That's the correct option. C. C it is. Again, a computation question. Under the US GAAP, Xavier's cash flow from financing and cash flow from investing. Let us analyze each one separately. Financing and investing. Cash paid to suppliers for merchandise operating. Cash received from customers operating. Cash paid for the purchase of equipment. Investing outflow. Dividend paid, financing outflow. Cash received from the issuance of preferred stock, financing inflow. Interest received on short-term investments, it's an operating inflow, ignored. Wages paid, operating outflow. Repayment of bank loan, financing outflow. Cash from sale of land, investing inflow. You just have to add these up. Let us first do this for investing. 22 negative and 12 negative. 22 cash from sale of land, it's an inflow. So 22 plus 12 should be 10. Still negative, 10 negative. Cash flow from financing, negative 2. -5 plus 10 plus 3. So that makes B to be the correct option. So remember, this was cash from sale of land is an inflow, investment inflow. Rest of it is fine. So we got B as our correct answer. B it is. Question 75. The sale of obsolete equipment. Clearly, it's an investing flow, investing cash inflow. When you sell an asset, it's an investment inflow. When you purchase an asset, it's an investment outflow. This is a very good question, I must say. It will test you in a different way. We have been given the prepaid insurance balance opening, closing, interest payable opening, closing, the actual payments made during the period for insurance premium for the year 2007, 750, interest paid for the year 2007, 900. These are the payments made for the prior year. We are currently considering the current year, so they are irrelevant. What is required? Insurance expense and interest expense for the periods. Let me draw the formats for you. It's very handy. Conventional accountants, the old-fashioned accountants like me, they use this traditional method. It's very helpful. Never make a mistake in this method. Let us construct these two accounts, insurance and the interest payment. Of course, they are the expenses. Insurance prepaid at the start of the period represents an asset, opening balance. Insurance prepaid at the end of the year represents an asset at the end of the year. That is the closing balance. Interest payable at the start is a liability to be shown on the credit side as the opening balance, and 300 as a liability at the closing side, closing balance. It says insurance premium paid. This is what we have paid. Debit insurance, credit bank. Bank is credited, insurance would be debited by 750. This has been paid out of bank. Interest paid 900. Debit interest expense account, credit bank. Debit interest and credit bank somewhere. The balancing figure to this side is the charge for the year, charge to income statement. Both sides are balanced because we have the carried on balance. This balancing figure on both sides is in fact the charge to income statement, expense for the period. So it's 650 plus 750 less 475, 925. Insurance expense is 925. For interest, 900 plus 300 less 250, it's 950. So 925 is the insurance expense for the period, and 950 and 925 respectively, insurance expense and interest expense. So that makes B to be the correct option. B it is. Quite a handy method. Just plug the figures in the right places and you will never get it wrong. Next, calculate cash flow from operations using the direct method and indirect method both. Direct method and indirect method both. Let us first do the direct method. In direct method, what we do, we take revenue as inflow. CGS is considered as an outflow. Cash operating expenses is considered as an outflow. You can make a shortcut. Cash flow from operating activities using direct and indirect method would definitely be the same all the time, B. But we are learning, not guessing. So for that we have to do the working, because whether direct or indirect method, the result should be the same. So that can just help us to click the right option. But we need to convince ourselves that we have learned the trick of the trade. So 100 less 40 less 20. We don't take depreciation in the direct method. No depreciation. Tax expense, yes, it's a payment. Increase in accounts payable over the period. If accounts increase in account receivable, it means it's an outflow. Increase in account receivable, it is shown as a deduction from it. We'll let us show it as a deduction from here, 7.5. Decrease in stock, it means we have sold, it's an inflow. Increase in short-term notes payable, it's a financing inflow. Ignore. Decrease in accounts payable means you would have paid to your supplier. So if you net these all, 100 less 40 less 20 less 3 less 7.5 plus 2.5 negative 1 gives you 31. Right? Let us do it in our conventional indirect method where we start from net income, starting from net income, add to it the depreciation expense in total, 5. What else? Nothing else. 32 is net income, add back depreciation. Increase in accounts receivables, effectively outflow. Decrease in inventory, inflow. And finally, decrease in accounts payable, you would have paid, -1. So starting with 32 plus 5 less 7.5 plus 2.5 less 1 gives you the exact number 31. So that's how we do it under direct and indirect method. So that makes B to be the correct option. Convinced? B it is. Next, non-current assets on the balance sheet are most closely linked to which part of the cash flow statement? Non-current assets relates to investing inflows, outflows. Without doubt. B. Non-current assets relates to investment activities, investing cash inflows, outflows. Again, Independence Incorporated reports interest received and dividend paid as a part of its cash flow from operation. This treatment is acceptable under what? Dividend received, interest received, dividend paid are treated as a part of operations. This is allowed only in IFRS but not in the US GAAP. Allowed in IFRS but not in the US GAAP. That makes A to be the correct option. We have done many questions like these. Next question. Use the following information to calculate the cash flow from operations using the indirect method. Indirect means you start with the net income, add depreciation, loss on sale of machinery to be added, increase in account receivables, they didn't pay, deduct, decrease in accounts payable, you have paid, deduct, increase in income taxes payable, you didn't pay, add, and repayment of bonds is a financing cash flow. 12 plus 1 plus 500 minus 2000 minus 1500 plus 500 gives you a positive number of 10,500, increase in cash of 10,500. That makes B to be the correct option. B it is. Next, interest payments either as a part of coupon payment or to creditor are considered which type of cash flow under the US GAAP? US GAAP explicitly says that interest payment are considered as an operating outflow to be shown in cash flow from operating activities. B. An analyst compiled the following information for Universe Incorporated for the year ended December 31st, 2004. Using the indirect method, which I love, what was Universe cash flow from operating activities? Because that's what I've been using in my professional accountancy career for the last 20 years. So I'm comfortable with this method. And if there is no such restriction on the exam, I recommend using the indirect method. So to start with the net income, to it add depreciation. Common stock is financing cash flows. Preferred stock, financing. Common stock dividend, financing. Preferred stock dividend, financing. Equipment with a book value of 50 was sold for 100. So it means there is a gain of 50. This gain must be deducted. So starting with 850 plus 200 less 50 gives you $1 million. And that is the correct option. B is the right answer. Next. The net income for Miller Bat Company was $3 million for the year ended December 31st, 2004. Additional information is as follows. What do we need to calculate? Under the US GAAP, the net cash provided by operating activities in the statement of cash flows for the year ended December 31st, 2004. Starting with the net income, add depreciation fully, gain from cash sales of land, deduct, increase in accounts payable, you didn't pay to your accounts payable, it's an inflow. Dividend paid is considered as a financing outflow. So very simple question. 3 million to it, add 1.5 million, deduct 200,000 and then add 300,000 back. So it gives you 4.6 million. B is the right answer. Next. Under the US GAAP, the actual coupon, actual interest payment on bond is reported on the statement of cash flows as an operating cash flow. We have done this question many times. So we have no doubt that it's C. Under the US GAAP, taxes paid would be classified without doubt operating cash flows. C. Under the US GAAP. When calculating cash flow from operations using the indirect method, which of the following is most accurate? The indirect method requires an additional schedule to reconcile net income to cash flows. Wrong. In fact, The direct method requires an additional schedule that reconciles your net income to the cash flow from operations. It's a wrong statement. When recognizing a gain on sale of fixed assets, the amount is a deduction to operating cash flows. Yes, gain is deducted without any further ado. B is the right answer. Go no further. Let's see why not C. In using the indirect method, each item of the income statement is converted to its cash equivalent. Ridiculous. 87. Which of the following statements regarding depreciation expense in the cash flow statement is correct? Depreciation is added back to the net income when determining CFO using the indirect method. We have done it many times. In indirect method, the depreciation is added to the cash flow to the net income. A, without doubt, A. Which of the following is not a cash flow from operations? Net interest payments, cash flow from operations. Dividend received under the US GAAP, cash flow from operations. Dividends paid is a cash flow from financing activities under the US GAAP. B. Which of the following choices most accurately illustrates an operating liability and which most accurately illustrates a financing liability? Customer advances is an operating liability. Correct. Accrued liabilities is also an operating liability. Incorrect option. Short-term notes, it's a financing. Current portion of long-term, it's a financing. Accounts payable, yes, it's an operating liability. And current portion long-term, that's a financing liability. O, F, C is the right answer. C it is. To calculate cash received from customers, an analyst would most appropriately do what? Subtract the changes in account receivables from net sales. Yes, we take net sales as positive, but this is little questionable because sometime account receivable increase over the period, sometime decrease. Remember, if they increase over the period, they are deducted. If they decrease over the period, then they are added over the period. So this is half true. But nonetheless, net sales needs adjustments for account receivable. Sometimes they're added, sometimes they are deducted. Subtract account receivable from gross sales. We don't take gross sales, we take net sales. Add the change in account receivable to credit sales. We don't take credit sales, we take net sales. So this option B and C can straightforward be rejected. A is correct but partially correct. But we need to get our concepts cleared. Net sales, positive. If there has been an increase in account receivable, it is deducted. If there has been a decrease in account receivable balances over the period, it is added. That is the concept that we should fix on our mind, irrespective of what this option says, which by the way is right, A, but we need to get our understanding clear. Under the US GAAP, interest paid would be classified as, without doubt, we can click this option with the closed eyes. It's an operating cash outflow. Interest paid, interest received, dividend received, they are all considered operating cash flows. Dividend paid are considered as financing cash flows. So that's B. And that completes your MCQs, 91 MCQs on cash flow statements. Your reading is over.